I'm going to go ahead and turn the program over to Eli to introduce himself, to introduce Vestr, and to introduce his colleague, Stefan.
Hi, everyone. Thank you, Anna, for the introduction. My name is Eli Tolan, Senior Sales Executive at Vestr AG. Really quick, Vestr is a Swiss firm based in Zug, and we offer a comprehensive product management tool that handles everything from portfolio management, portfolio rebalancing to investor reporting and audit trails. I'd like to also introduce my colleague, Stefan, who just joined us. If you'd like to introduce yourself, Stefan.
Yeah, thank you for being on the call. I'm Stefan Wagner. I'm the head of business development at Vestr. I've been with the firm now for nearly 5 years, and I'm looking forward to this conversation and webinar today.
Fantastic. So I think we can get started. If we can go over to the first slide there. You can go to the next one. Super. So today we'll be going over 2 asset classes, which we have seen significant growth in Europe and also increasing interest among some of our users, namely AMCs and SMAs. So let's get started with AMCs, or actively managed certificates. AMCs can be defined as structured products whose underlying strategy and the components of which are rebalanced or adjusted over their term, and also at the discretion of an asset manager or portfolio manager. So in short, they allow the asset manager to run an entire portfolio as a single instrument while also maintaining the liquidity and transparency of a traditional exchange traded security. Important to note here that AMCs have many labels, such as exchange traded notes, exchange traded products, strategic index certificates, and that's just to name a few. You can see on the slide here, we've listed some of those for you. Next slide, please. So where have we seen kind of some of the interest, or where is this growth coming from within the AMC space? Well, a lot of that has to do with the adaptability and the cost effectiveness within dynamic investment strategies. So with AMCs, you're able to link traditional securities such as bonds and equities, as well as non-bankable assets such as real estate or collectibles. And you can do that all within predefined index rules. So you could set those rules based off of credit ratings, certain jurisdictions, what have you, and also on the performance. A little bit from the regulatory perspective, we mentioned they're classified as structured products, but more specifically as debt instruments. And they can be issued both publicly and privately. To launch such a program, typically you need to have an offering document, a final term sheet, a program document, and some fact sheets or some other product supplements needs to be included. Hopefully we'll hear a bit more in a bit. We'll hear a bit more about some of the cross-border considerations for AMCs in the US, as these products are mostly currently in Switzerland, Luxembourg, and Ireland, or issued out of those jurisdictions. But nevertheless, another key aspect to the growth that we've seen is the time to market. So AMCs can be typically issued within 2 to 3 weeks, as opposed to for ETFs, it would be like 2 to 3 months. So that's a brief overview of AMCs as a whole. I'd like to pass on now to Stefan, who would show you a few numbers as to how this market has been growing and some of the trends.
Okay, so I mean, the markets are, the interesting bit about this product is probably because it has such a fast time to market. You also need much smaller AUMs to start something. I mean, our clients, to give you an idea now, launch some of these products just only with 1 million AUMs, when probably, I don't know, 3-4 years ago it was still at 5, but in comparison to the mutual fund, that's significantly below, so you can start building your track records. But we see more and more markets opening up to that one, while this was probably initially mainly only used in Switzerland and surrounding countries. We find it extensively now, so in Singapore, South Africa, Middle East, and even Italy, which is historically always a bit slow when it comes to structured products. These, as I will get into later, but these AMCs can be issued either by, let's say, banks of their own balance sheet with their own issuance program, structured product notes issued. But more and more we're seeing SPVs being used to do this, particularly to convert non-bankable assets like hotels, even collectible cars. We even have AMCs on the platforms that have jumping horses in it, who get trained and 18 months later get sold, and that's the thing. And what these securitization vehicles now do also, which used to be historically purely private placement out of Ireland, in particular Luxembourg, is that they start listing them, so they also become literally available public distribution. So the LSE has listed such products, Milan and EUBAX was market making. So it's not an MTF, it's a proper market making. The other thing that we're seeing more and more historically, there was just let's call it a synthetic basket or basket of underlines. You got access to it, but more and more convert these indices, these strategies into indices, and that I think is partly because these indices are more and more allowed to be more complex regarding the rules of calculations. Partly also is that because many of these indices, or more and more of these indices, now allow artificial intelligence in their index calculation, or the reasoning that happens why a certain underlying gets picked or reduced out of the index, basically. Everybody often asks us how big is actually that market, and it's probably approximately 1.5 trillion in AUMs outstanding, but it's booked mainly in Asia and Europe. That doesn't mean the clients are all in there, because often the issuer might be in London, or he might be in Luxembourg, he might be in Ireland. The client might be in Latin America, but the booking of the trade actually might happen in Switzerland, for example. So it's always often three jurisdictions often involved in it. And we sort of find there's two different of types of styles, what I would call the fund style. And that is basically behaving like a fund where you invest in a basket. If a new cash flow inflow comes in, it will be, it's up to the investment manager to determine how they want to deploy that cash, versus the certificate style, which is basically an index. If a new inflow comes in, it gets equally, the same way distributed as the current weights, basically. And what we see used to be more and more popular, but it's less popular at this point in time, is to have leverage inside the product. Excluding derivatives, often you find a lot of derivatives. And the reason why you probably haven't seen much of it is because the majority of all these products are privately placed, at least 95%, if not more, but the trend is going that way. And the other one is that what is interesting, that probably 1/3 of all products that at least we have on our platform include structured products in it, again, in a sense like a bonus certificate or some other form of securitized derivative.
So everybody asks us, so what are the typical underlying asset classes in these products? And probably nearly 50%, as you can see, is purely stocks only in a sense. And even if you then at that point would add just stocks and ETFs, you get way more than 50%. And if you do normal mutual funds as well, you probably that's 70%. And then anything else after this is probably little add-ons like option and futures, but nearly you can really, with all these four, if you would only provide that, you can cover pretty much nearly 3/4 of the market. Thank you. So the two main players in this, as you probably heard me talking about a little bit, is one is the typical on-balance sheet issuers, either investment banks or private banks, and often they already have a structured note problem that issues structured products, and you find them obviously because they either have a QIS, a quantitative investment strategy, or an existing Delta One or prime brokerage business. For them, then leveraging into an AMC business is very easy. It mainly comes then down to how do they handle all the data points that happen and the in and outflows, rebalancing and everything else. That's sort of where Vestr comes into it. But that's the typical things. A lot of the Swiss banks obviously do it, but you find them also the international big global banks sit in London and New York. And then the other one clients, the sort of how we distinguish is the off-balance sheet issuers. And that's sort of the SPVs, the securitization vehicles. And in jurisdictions where you sort of the concept of bankruptcy remote structure, so either Luxembourg and Ireland or Guernsey and Jersey, where you have these cell companies. And there you often find more products that are either non-bankable assets or trying to give access to crypto, or very high frequency trading strategy that they call it the on-balance sheet issues. The investment bank and private banks are not willing to give them access. So they then use like brokers like Interactive Brokers who have a very good API to trade via with. And that's how also we distinguish between the two type of participants in that market. Thank you.
Super. Thanks so much for that, Stefan. So moving on to the second asset class, as we mentioned earlier, we have SMAs, or separately managed accounts. These products in many ways have some overlap with how they're structured with AMCs, but with a few key differences. So a separately managed account is a personalized investment portfolio that is usually bespoke to the investor's needs. And it's also managed similar to an AMC by a professional portfolio manager or asset manager that can hear the requirements and the parameters that are set by the investor, and then try to create the best portfolio for them as possible. So again, similar to AMCs, but also with ETFs and mutual funds. Within an SMA, you have a diversified basket of stocks, bonds, and other financial instruments. However, here the key difference comes in that within an SMA, you are the owner of those underlyings. So as opposed to with a fund or even with an AMC, as we mentioned, which is classified as a debt instrument, you are receiving exposure to the fluctuations in the market of those underlyings, but you don't own any of them. Whereas with an SMA, you absolutely do. And this also differs from other, pooled vehicles as well. So everything goes into a single unique account, right? You're not sharing that account with anyone else, as the name suggests, right? Separately managed accounts. This comes with a few advantages. As I said, next slide, please. So first of all, the investor has quite a bit of control as to what goes into the underlying. So they could align with whatever ESG requirements they have, right? So they could set restrictions saying, I don't want exposure to any underlyings that have poor ecological ratings, for example. And they could also do it by industry or by credit rating, or even the maturity of the underlying. They could manage that together with their portfolio manager. And then again, still take advantage of the work of professional portfolio managers and advisors to optimize that portfolio or that basket as best as possible. In addition, you have all of the transparency that you would expect with, as you would expect with mutual funds and ETFs and other exchange-traded products. So you have access to all the real-time account balances because you own them. You get regular performance transaction reports and also clearly defined fees and costs. Another big element here and why we've seen quite a few investors interested in such an asset is because of the tax gain and loss harvesting. So again, as you are the owner of all of the underlyings, that becomes quite a bit more, quite easier to manage as opposed to if you were with a debt instrument or something like that. So that's just a very, very broad overview of SMAs. I'm not sure, Stefan, do you have anything else you'd like to add to that?
Yeah, I mean, I think some people often see the AMC actually just in the way of securitizing a segregated managed account, a separate managed account. That's oft, and because you can do them in quite small size, you can even, if you have 1 million, you can set up even an AMC dedicated just for one client, basically.
Absolutely. And I think from a let's say a market perspective, SMAs are targeted to investors of, I wouldn't say, let's say, ultra high net worth, but more kind of somewhere in the middle, just high net worth individuals that have a little bit more risk appetite, but maybe also have more are looking for a more diversified portfolio. So that certainly works for them. Yeah, fantastic. So perhaps from here we can hand over to our friends at Mayor Brown and understand some of the regulatory aspects of the US with these two asset classes, and some other interesting insights as well.
Well, actually, we're going to talk a little bit about Europe before we wander over to the US.
Super.
Yes, hello from myself. I'm Patrick Scholl. I'm partner at Mayor Brown, located in Frankfurt, Germany. Yeah, and I will accompany the introduction by our colleagues from Vestr from a legal perspective, or from a European Union perspective in particular. I don't know whether Marla or Anna, you can show our slides that we prepared. First of all, let me introduce from our perspective an AMC. So I'm talking about AMC. It's a structured product, a structured product within a strategy, and so it's a security. And how this finally will be established and implemented in practice, there are many legal ways. I think you already explained the potential issuance structures. So you either can have a on-balance sheet issuance. So you have a bank, for example, that is a maybe frequent structured products issuer. And they, in addition to their normal structured products program, issue then certificates that are linked to the strategy. I'm following up on what is linked to the strategy mean. On the other hand, you already explained that there can be issuance vehicles in jurisdictions where we have issuance vehicles. This means finally you have to build and set up a special purpose vehicle in line with the laws there, and then create the instruments and maybe segregated pools in order for the instruments, in order to ensure that they are bankruptcy remoteness, which is a big topic. Finally, when you issue the AMCs out of also special purpose vehicles, and there are many jurisdictions in Europe, for example, that offer these kind of segregation mechanism. And the final issuance structure that is not so popular in all European countries is a kind of a fiduciary issuance structure. And in the fiduciary issuance structure, we have a national law, national insolvency law, that enables, as part of the issue, to create segregated pools, so that these pools are on balance sheet, but they're segregated from the insolvency estate once the issuer goes bankrupt, so that there's a separate pool then for the purposes of the investors investing in the AMC that is backed by this separate pool. So it's a bit like a asset-backed structure, even if it's not an asset-backed security. But the mechanics are sometimes similar. So these are the legal structures. We see the on-balance sheet structures are more straightforward. You have a security, it is likely cleared at the clearing system, it can be traded, it can even be listed. With a special purpose vehicle, you can also have cleared and listed securities, but you have to have all the infrastructure and surrounding that SPV so that it can work. So you need agreements in place and everything like that, so that there's an administrator or manager managing finally the SPV. So this is the legal structure. I just want to frame what is then relevant from a European law. No, the previous slide, please. From European law when it comes to regulation, because what I can already say now, there's no clear-cut solution, given that that the IMCs have different structures, and even though as we have in Europe harmonized overall harmonized legal framework in capital markets, we still have national legislators, and in particular, if structured products are focused, there are different views of legislate and supervising authorities on whether they are comfortable or not with the product. Yeah, so they've definitely oversight that market and look if there are anything that can, for example, from a MiFID perspective or from a securities trading perspective, could be problematic from their perspective in order to protect investors. Yeah. So I'm now just guiding you through to the relevant regulations that you have to think about when doing AMCs and what we as lawyers then finally test in order to ensure that we are within our outsider regulation and what this means as a consequence thereof. So first of all, as we have a security, it can be a requirement to publish a prospectus. In particular, as this is also sometimes focused on if you want to issue these AMCs to potential retail investors. So you could, in that case, trigger prospectus requirement, and under the prospectus regulation, you then have to comply with minimum content requirements. And for products that compile a strategy, it's quite complex because you need to be ensured that all the relevant aspects of the strategy is set out in the prospectus. Yeah, that's quite a difficult task sometimes, because sometimes there's also there's a lot of discretion involved, and if a lot of discretion involved, then the question how you transport the discretion and make investors comfortable with the underlying strategy. Then if the retail investor involved, even though it's not a public offer, you can become subject to the PRIPS regulation, have to pay a PRIPS document for that retail investor, even if it's a very rich one. So this is also a regulation to keep in mind. When distributing products, we have in Europe the product governance rules and the MiFID. So for example, there is the test whether the suitability of the target market is giving, in particular if retail investors are targeted or high net worth individuals. And the other perspective of the product governance rules are the product intervention measures. So if a product would be seen by a regulator as being maybe too dangerous for investors, or maybe there are other topics that they see there that the strategy could be too risky or could maybe not be fair. There could be there's in the end still some investor protection measures on the side of the regulator, and they could even ban a product. Yeah, that's always to keep in mind when doing structured products based on a strategy. Next slide. Given that I talked about strategy, yeah, there are two things, two possibilities how to build in the strategy into a structured product. Either you create an index, an external index, how I name it, yeah, and this is then the reference of the product, or you can even include the strategy into the terms of the product. In both cases, the benchmark regulation can come into play, and because the strategy and the rules of it can be used in a financial instrument by a supervised authority. In that case, it could be an index, and if it is an index, then you have to comply with the benchmark regulation, in particular that the index or the administrator must be registered in the ESMA register. There's still the index, the benchmark regulation applies to European Union administrators. Yeah, so if there's a third country benchmark administrator, like if the administrator is in Switzerland, yeah, then there's still a transitional provision ongoing in the European Union with regard to the application of the benchmark regulation. But at a certain point in time, also this benchmark regulation could kick in for third-party index providers. There's still not a clean-cut solution with regard to whether the instruments or the security that implements the strategy directly can be considered as an index or not. Yeah, we had discussions in the past also with the regulator, and I can tell you it might be easily also fall within the definition of an index, and then the security as such implementing the strategy in its terms could be regarded as an index for the purposes of the benchmark regulation. So this needs to be very carefully analyzed if the strategy is directly implemented in the product. Then what, giving all the management, yeah, and also the term fund has been mentioned before, we always have to distinguish AMCs from funds and from the regulations on funds, yeah, because structured products as such are not subject to the funds regulation, but there are material definitions of what creates a fund under the European Union regulations, also with regard to distribution of the products or the prospectus requirements, etc. So it has a separate legal regime in the European Union on funds. And then if such an issuance structure, for example, like by a special purpose vehicle or so is used, then given that there's a strategy involved, we have to differentiate from a fund and have to do a careful analysis of the 8 qualification things that creates a fund compared to a structured product. So it's very decisive because you either fall then in the regulation of funds or you fall into a regulation of securities. And finally, the last thing I want to say is liabilities. Yeah, liabilities, they're always involved in issuance of structured product. So once there's a prospectus involved, you can be subject to prospectus liabilities, particularly as a dominating factor with regard to strategies if they create a lot of discretion, because investors then look at what has been disclosed in the prospectus and whether that created a bit of can be created a suitable basis for their investment decision, or whether they simply say there has not been enough information for us to understand what the product is about. And finally, mis-selling rules, and then I stop here. Mis-selling rules are also subject to national laws, yeah, but it's also the question whether the product is sold to a suitable investor or not.
So Patrick, before we go on to talk about the US, what about novel assets or asset classes or novel strategies?
Yeah.
So
Yeah.
Crypto or artificial intelligence related indices, are there special rules or concerns?
We see the development of new asset classes, yeah, and the rules are from the face of it the same, yeah. Whether from the ones that I just outlined, the only difference is the suitability perspective, for example, or whether there are certain national legislators that don't like crypto assets as underlyings. Yeah, there are some in Europe, yeah. Some are more, for example, like in particular crypto assets. And I think where other strategies like artificial intelligence can come into play, then it's also a question whether, yeah, regulators like this from an investor protection perspective. Yeah, so it really depends also on the investors that are targeted, and whether it is a product that is finally no longer controllable by an investor, and then could be seen as something that is so risky that it could maybe an investor and regulator could not like. So there's always the possibility to ban products if they are distributed into European Union, and this is why it's need to be carefully analyzed how the artificial intelligence is implemented also for the purposes, for the benefit of the investors. And it's finally a question of risks versus chances.
Okay, so the same interest that I'm sorry. So there's a question, so we'll answer this in for Europe, and then the answer may be a little different for the US. So the question, where does the liability lie for investor suitability? Mm-hmm. Is it on the distributor or the investor's bank who's supposed to check its client eligibility and the category?
Yeah, it's mainly and likely on the distributor side. Yeah, the one that is required by law to do the suitability analysis. Yeah, we do a lot of sustainability, not yet. So it's their decision. Finally, they are in direct contact with the investors. It must not be with the issuer. Yeah, but the issuer could nevertheless be liable for any kind of documentation, etc., that has been prepared in connection with this. And what we can also not exclude, there's some kind of back-to-back liability between distributor and issuer. Yeah, also depending on who takes risk and for information, whether, for example, the distributor has been giving sufficient information to present the product in a correct way to the investor. So it doesn't mean that if the distributor is liable at in the first step, yeah, that there couldn't be any kind of back-to-back liabilities.
Okay. So as I was saying, the same level of interest that Eli was talking about at the outset of the presentation, interest in actively managed strategies that is present in Europe, is present in the United States and in Latin America. And so that leads to the last bit of our discussion, which is how some of these products can be sold to investors outside of Europe, whether in the United States or in other jurisdictions. And Marla is going to get us started on that.
For separately managed accounts, legally speaking, slightly different footing than the European view. The accounts is doing a lot of work for us here. It's not a security, meaning you don't have to worry about finding a securities exemption. It's an account. And importantly, it's also not for 40 Act purposes a fund. What you do need to worry about in connection with the SMEs, however, is Advisors Act concerns, which Anna will speak to a little bit more down the road. Actively managed certificates, on the other hand, while similarly not a fund, are securities. They're debt securities either issued by a financial institution or an SPV, depending on how the particular issuance is structured. And as securities, you do need to worry about exemptions under both the 33 Act and the 34 Act. So under the 33 Act, as we're all very familiar with, you need to either register securities or find an exemption. And because of the nature of the market and the nature of the product, are sold pursuant to an exemption. We have our usual suspects, either Reg D, 144A, or Reg S. If you're looking to sell pursuant to Regulation D, typically we're talking about setting up a transaction pursuant to 506B, including the restrictions on general solicitation and general advertising. And in connection with that, you would also have to worry about accredited investors. If your transaction is limited to accredited investors, which is customary for the AMCs, you don't have the limit on investors. Both of these requirements, the advertising and the restriction to accredited investors, are usually set forth in the distribution agreement for compliance in connection with whoever is distributing. You would also typically have deemed reps or some sort of representation from investors as to their accredited investor status. The other thing to consider with setting up an issuance pursuant to Reg D is that these will be restricted securities. Typically in the transactions we've seen, there's some sort of issuer or distributor approval of any resales where you would monitor this, but Reg D securities are restricted resale unless pursuant to Rule 144 or 1. Finally, the The other thing to consider is that you will need to file a Form D following the completion of any Reg D offering. And you will also want to consider any potential blue sky considerations. And finally, any bad actor concerns. So Reg D offerings require that the issuer and any placement agent connect due diligence. None of the parties involved in the offering are bad actors who violated certain U.S. securities laws. This requires a factual inquiry. This is typically handled via rep letters or some sort of public database check, combination thereof. Moving on to other alternatives. Melissa, if you want to move to the slide on Rule 144A. The other option is Rule 144A to quibs. This is a resale exemption. So you would still need to consider 4.2 for the initial sale. The main thing to consider here that could be problematic, depending on how you've structured your issuance for the AMCs, is that Rule 144A does require certain financial information of the issuer to be available, including financial statements. And then finally, we have Regulation S. So this is, as many of us know, an exemption for offers and sales that are made offshore with no efforts in the United States. Where we're seeing this in connection with AMCs would be if you're using some US touch points to sell into Latin America or other areas. Just a note similar to Reg D and 144A, these subjects could be restricted after issuance, just something to keep in mind. And then now that we've covered the Securities Act, time to move on to the Exchange Act. So US broker-dealers, you're already registered, you're used to these requirements, but importantly, under the 34 Act, any foreign broker-dealer who is engaging in any conduct in the US would need to either register as a broker-dealer or act solely pursuant to an exemption from registration. Typically here, we're thinking you would be acting pursuant to one of the 15A6 exemptions. So those exemptions include unsolicited transactions, transactions to certain institutional parties, chaperoning arrangements, people transiently in the US, etc. So I think the first one to discuss would be the unsolicited transactions. So foreign persons are allowed to conduct very limited broker-dealer activities without registering if there's been no solicitation. The term solicitation is not specifically defined, but there's been various regulatory guidance through the years. Importantly, solicitation is a very broad definition. It can include efforts to induce a single transaction or an ongoing business relationship, or even just general activities to publicize your broker-dealer business in the United States. And importantly, frequent transactions are also considered indicia that there was some sort of solicitation. Given how broad solicitation can be interpreted, this is a little bit of the exemption of last resort. Typically, if at all possible, you would rely on one of the other 15 A6 exemptions. Those are either the status of the purchaser exemptions or the chaperoning exemptions. So under 15A6A4, you have the exemption for certain institutional purchasers or certain foreign persons, being non-US citizens, non-permanent residents that you have an existing bona fide relationship with, who are just transiently in the US, or you also have certain limited activities for US persons who are, for all substantive purposes outside of the United States. You're not targeting them, they're just existing in a foreign country and you have a relationship with them that way. Then the final option would be the chaperoning arrangements, meaning a broker-dealer selling to institutional clients who is chaperoned by a U.S. broker-dealer. Typically, the way in which you'd see this in this context would be for sales to RIAs that are placing in discretionary accounts. Now that we've done 33 and 34, I think it's time for the 40 Act and the Advisors Act, and I will turn things over to Anna.
Okay, folks seem to have woken up, so we've got lots of good questions. So I'm going to answer the questions first because they're fun. If an SPV structure is used and a single investor buys the AMC, who is considered to be the distributor? Assume no bank is involved, just an investment manager and an investor. Okay, so this is like hypos in law school, which I love. So in this case, you could have a situation where you have an issuer dealer in the United States, and the issuer itself would be potentially considered the dealer and would be considered itself to be making the offer and soliciting. So that would be your answer. An issuer dealer would generally need to limit its activities in terms of soliciting. So, but if you have a single investor, then you should be able to fit within the issuer dealer exemption from broker dealer requirements. So that's what we would say to that one. The next one, can US brokers make available non-registered, so exempt, European AMCs to any type of US investors? So I think Marla kind of answered that, right? If you have an AMC that is being actively offered in Europe and it complies with the regulatory scheme that Patrick talked about, it hasn't been registered in any fashion with the Securities and Exchange Commission, and there's currently really no way to register AMCs in the US. How would you sell it in the United States? So you would rely on one of the exemptions that Marla talked about, sell to QUIBs and probably to QUIBs who are qualified purchasers if it's not an on-balance sheet vehicle. So if it's not being sold directly by a bank, if it's being sold through a special purpose vehicle, easier if it's being sold directly on balance sheet. Then we have the next one, which is, how does this fit in? Generally, it's a long question, but how does this fit in with Volcker? And is this sponsoring a fund as per the Volcker rules and so on? So a couple of questions here. Two parts, right? So if this is a separate account, it's an account, bank account, so not a fund or a covered fund under Volcker. If we have an AMC that's on balance sheet, then it's directly offered by the issuer, so namely a financial institution or a bank. So no special purpose entity, so it wouldn't be a fund and you wouldn't indirectly consider it a covered fund. If it's offered by a special purpose entity, sure, you have to look at whether it would be a covered fund, but generally you wouldn't think of it as a Volcker covered fund if the bank or bank holding company or banking entity for Volcker purposes doesn't have, it doesn't have an ownership interest. And in most cases, the way that these are structured, they would not have an ownership interest, but obviously a great question. So feel free to keep these coming in our last few minutes. So on the 40 Act side, this comes up in the case of AMCs, not in the separate account context, because we don't have to get there with the separate account. So in the AMC context, this comes up, and it may seem curious to non-US, to folks not accustomed to dealing with the 40 Act, we would have to think about this in both cases. So we have to think about this when we have an on-balance sheet AMC, and we have to think about it more seriously when we have an AMC that's issued through a special purpose vehicle. So the 40 Act is intended to regulate passive investment vehicles, and we always want to avoid being regulated or having an entity that's regulated as an investment company, because it's a fairly rigorous regulatory framework. And while AMCs in many respects and separate accounts in many respects mimic many of the advantages of fund-like products, they're quite intentionally not funds and not subject to fund regulation. So next page. If you have an AMC that's issued through a special purpose entity, you would want to consider what the 40 Act exemption is. By and large, you would, as I mentioned, limit your sales to QUIBs who are also qualified purchasers. So by limiting your sales to QUIBs who are qualified purchasers, you could rely on the 40 Act exemption available for sales only to qualified purchasers, and then impose a super Reg S prohibition, so no sales even past the usual seasoning period to persons who are not qualified purchasers. So that would be one way of approaching it if you wanted to rely on that. You also have to think about it in instances where you have an on-balance sheet product where you're providing a Delta 1 type of return. And that may seem counterintuitive because you don't have a separate passive investment vehicle. You don't have this separate legal entity. But the analysis here is almost like the analysis when you have a Delta 1 structured note. And here the theory is that from time to time, the Securities and Exchange Commission has looked at Delta 1 products, and particularly the underlying when it's a basket of stocks or a narrow-based index. And this is where the underlying are securities. You don't have to worry if the assets are something other than securities, although securities for the 40 Act is very broadly defined. You have to consider whether by providing Delta 1 exposure, you've created a de facto investment company. So that requires its own very detailed analysis with counsel, whether you have or the Securities and Exchange Commission would think of an on-balance sheet product with Delta 1 exposure as a de facto investment company. There are a number of cases on this, as well as no action letters that provide some guideposts regarding the factors that one would take into account in coming to a reasoned conclusion on this point. So if we go to the Advisors Act, the next slide, the Advisors Act comes up in both contexts, the SMA context and the AMC context. So the SMA product is an account, as we said, so not a security, a bank account, or a managed account, depending on how it's structured. So it does require the participation of, in the United States, of a US registered investment advisor. So that's a given. In the context of an AMC product in the United States, you do have to think about whether you're tripping Advisors Act issues. So does the mere offering of an AMC to persons in the United States trigger any kind of registration requirement, or does it mean that the sponsor of the AMC the person involved in distributing the AMC, the index provider, or the person doing the selection of the securities or the stocks in the portfolio. Are they holding themselves out as engaged in the business of providing advice such that they would be required in the United States to register under the Advisors Act? So that's something to consider, and would maybe prompt whether you would want to sell an AMC into the United States, even to quibs, or whether you would want to entirely avoid the United States and perhaps limit AMC sales, for example, to only dealers in the United States in reliance on Reg S, and sell to dealers in the United States who are going to rely on Reg S and then sell in reliance on Reg S, let's say, to Latin America, where there's significant interest in managed products like AMCs with active portfolios. So if we go to the next slide on the Advisors Act, as we point out, if you do only Reg S transactions, it's possible that you could come to a conclusion, depending on the facts and circumstances, that no advice is being given to US persons. It's also possible to find other alternative approaches. Again, very fact dependent. So we point out a number of other alternatives. Each would be subject to interpretation and would be subject to how these products are being offered and sold and the participants that are involved. So for example, whether the principal activities are those of a broker-dealer, and there are really no advisory services, and any advisory service is solely incidental to the distribution services. So the principal services that are being conducted in the United States are merely broker-dealer or distribution services, and there's no special compensation that's being paid for the advisory function. Maybe there's no fee that's allocated or allocable to the advice component. And there are other exemptions that are available under the Advisors Act, so for private funds and for foreign private advisors. Those might be available. Again, they're very fact specific, but all of these would require a discussion, and maybe we'll leave it at that for now. On the next page, I think we have some information at the end about Vestr, and we will let our friends Eli and Stefan maybe have a last word.
Thank you so much for that, Anna. I'm not sure, Melissa, do we still have those last two slides, or can we bring them up? Just give her a second. But while we're waiting on Melissa here, just a quick thank you to Anna and Patrick and Marla for the fantastic overview there. Very insightful, and I'm sure we have quite a few of our users that are with us here today that are very thankful for the information here. A quick, slightly more detailed overview of Vestr. So as I mentioned in the very beginning, we offer an easy to integrate platform that digitizes the lifecycle management of your actively managed investment products. Some of these products could be, or often are, AMCs and SMAs, but that also includes dynamic or actively managed ETFs and other exchange-traded indexes, exchange-traded products, etc. And the platform can handle everything from portfolio rebalancing, investment reporting, audit trails, fee setting, and etc. Next slide, please. So some of the key benefits that the Vestr platform provides. You can manage your investment products from pretty much anywhere. You have instant feedback between your issuer and the external asset manager, customizable reports. We really help and focus on helping our clients scale their businesses. So you can have an unlimited number of products on our platform. You can manage quite an extensive degree of complexity within the product itself. There are no fixed costs, and we also align our fee structure with your business model itself. From a regulatory perspective, we again assist with audit trails, tax reporting, transparency. We have a white label reporting system, so you could essentially create your own template and have the reporting on a daily basis per product to distribute for audit purposes or also to your investors. And we also optimize our operations or help optimize operations for the users, where you can correct any product adjustments, moving away hopefully from some erroneous macros in Excel, but we also help execute trades in a timely fashion and correct any fee calculations. Vestr has more than 20 clients over many issuer clients over many jurisdictions in Europe, in Switzerland, Luxembourg, but also in South Africa and the United States and in the UK. Stefan, would you like to add anything to that?
I think you did a great job.
Closing
I mean,
remark? Okay.
probably the only thing probably to say to is that across these 20 clients that you mentioned, there's probably behind it 1,500 asset managers that are using the platform. Then it's so per issue there's hundreds of users behind it.
Well, we thank you both very much, and we thank our listeners. So we hope everyone has a good day, and we will be sending materials shortly.
Thank you very much.
Bye.
Thank you, everyone. Bye-bye.
Thank you. Goodbye.